attributes of an index and impact cost. In this video, we will break down how market liquidity, order books, and transaction costs work in a clear and simple way. To start, a good market index should have three main qualities. First, it should accurately reflect the market behavior, showing how the overall market is moving. Second, it must be computed by an independent third party, meaning it is free from the influence of any market participant. Third, it should be professionally maintained to ensure consistent accuracy over time. Before we talk about costs, we must understand liquidity. In the stock market, liquidity refers to a market where large orders can be executed without moving the prices. If you can buy or sell a lot of shares without the price changing much, that market is considered highly liquid. To see how this works, we look at an order book. The order book has two sides, the buy side and the sell side. For example, one side might show 1000 shares being requested at 4 rupees, while the other side shows 2000 shares offered at 4 rupees 0.50. The bid-ask spread is the difference between the best buy price and the best sell price. In our example, the difference is 0.50 rupees. If you buy 100 shares and sell them immediately, you lose that spread. This is the transaction cost for a small trade. Things change when you place a large order, such as buying 3000 shares. Often, there are not enough shares available at the best price. You might get 2000 shares at the best price, but the remaining 1000 shares must be bought at a higher price from the next person in line. As a result, the transaction cost increases for large orders. This means the simple bid-ask spread of 0.50 no longer applies because you are buying through different layers of the order book at increasingly higher prices. This leads us to impact cost. Impact cost is the percentage degradation you experience compared to the ideal price when shares are bought or sold. While an infinitely liquid market would stay at the ideal price, real markets have impact costs that vary depending on the size of your transaction. To calculate impact cost, step 1 is finding the ideal price. The formula is the best buy price plus the best sell price divided by 2. If the best buy is 9.80 and the best sell is 9.90, the ideal price is 9 rupees 0.85. Step 2 is finding your actual buy price. If you want to buy 1500 shares, you might buy 1000 at 9.90 and 500 at 10 rupees. By averaging these, your actual buy price becomes 9 rupees 0.9333. Finally, we use the impact cost formula. You take the actual price minus the ideal price divided by the ideal price and multiply by 100. In our example, the impact cost for buying 1500 shares is 0.84%. To summarize, the bid-ask spread is a fixed cost used for small trades. Impact cost, however, is a dynamic cost used for large orders that increases as your order size grows. Understanding these helps you navigate the true costs of the market.